So, like I said, today we'll be looking at IAS 12. And IAS 12 is on income tax. Income tax. And when we talk of income tax, the income tax for the purpose of our accounting is divided into two. We have the current tax and we have the deferred tax. Current tax and deferred tax. And deferred tax is not is current tax is just the tax charge for the year on the taxable profit of the company. We calculate it using the the provisions of the tax law. That is, we adjust the accounting profit to suit the taxation purpose, and we calculate our current tax, just like we do in taxation when we have to compute the CIT payable of the company. That is what we do in here. And that is what we call current tax, and that is the main tax that we pay for their companies pay for their activities. However, while we are at it, let's just quickly look at some this thing, what's it called? Let's quickly look at some terminologies that might be new to us on this standard. We have one, accounting profit. What is accounting profit? Accounting profit is more like our operating profit or our profit before tax. It's a profit we arrive at based on our accounting principle before charging tax expense. Before charging tax expense. While taxable profit or taxable loss is that one we calculate based on tax rules. Like where we do our accounting profit, we add back the salariable expenses, we less our non-taxable income and the likes. That is what we call taxable profit or taxable loss if it results into losses. And it is on that basis we calculate our taxes, either for accounting purpose or tax purpose. On that basis we calculate our taxes. What is current tax? It is the tax we pay for the current year. But tax is paid on preceding year basis. So we calculate it this year, we take it as a provision in the current year. Then in the following year, we will now take it as what? In the following year, we will now make the payments and we will just treat it as a reduction to our payables. Because when we create the provision, we have to recognize the tax expense and also recognize the tax expense, and we will also recognize the tax liability. Okay, so the next one is go on.
So
I can hear you.
If year 20x0, assuming year 20x0 is our current year, and we made a profit, and let's say the tax amount you are supposed to pay in actual amount is 10,000, then 20x1, which is the next year, let's assume that we made a loss. We have to carry that tax over now, right? We can't pay the tax.
Can you take that again, please?
The current year, assuming the current year is 20x0, we made a profit of a certain amount, and we are supposed to pay, let's say, a certain amount of tax. So, with the tax law, we cannot pay the tax that year. It's supposed to pay the preceding year basis. That will be 20x1.
Yes.
But in 20x1, on the actual basis, we now made a loss.
Okay.
I'm just trying to clarify.
So if you make a loss in the current year, you will pay tax of that previous year now. You pay tax of that previous year, but the loss you make in this current year now, you can now relieve that one against profit in the subsequent year. Is it clear?
Okay.
So that's why we say you make provision. You would have set aside the money you want to use to pay that tax next year. And so another thing is that is why government That is why the tax authority introduced something like withholding tax, because they know you may say you don't have money to pay the tax again. But if the people you carried out contracts with have already started doing the paying some things on your behalf before the end of the year, then you can now use that tax credit to reduce your what? To reduce your own tax liability. Do you understand? You use that tax credit to reduce your tax liability. So what you need to pay will not be much again. Is it clear?
Yes, sir.
Okay. Okay, so that is that. So deferred tax. Deferred tax is just an accounting measure we use to match the tax effect of transaction with the accounting impact. What does all of this mean? It means that in some cases, the taxation treatment of a transaction will differ from accounting treatment. So what we do use deferred tax to do is to now bridge that gap we have between accounting and tax and say, okay, if because of the provisions of tax law, this transaction we have now, we create a future tax liability for us, we use deferred tax to recognize the liability now. If it can create a future tax savings for us, we use deferred tax to recognize the savings now. That is deferred tax liability, and that is deferred tax. As you know, the word deferred just means what? Something that will occur in the future. So deferred tax is a tax that will arise in the future. It can either be a liability or an asset, but we'll still talk more about it. When we say tax base is the amount that is attributed to an asset or a liability for tax purpose. So with tax base is basically the cost of an asset less its depreciation, or what the tax authority will have in their own books as it relates to that transaction, as it relates to tax, to that transaction, as it relates to that transaction. So what else do we have? Okay, the next thing is what? The next thing is tax expense. Tax expense is just the aggregation of the amount that will be included in our profit or loss for tax in the year, and it includes both current tax and deferred tax. Both current tax and deferred tax. I will show us that. Deferred tax liability. I'm with you.
What is based and tax base? Tax base. Can you explain it? Sorry.
Tax base is just the value of an asset or a liability on, when we are measuring using tax basis. So when we say tax base for an asset now, it will be the cost of an asset minus its capital allowance. Minus its capital allowance. If we say this thing, if you say maybe it's just your cost minus capital allowance, and where there is no capital allowance on the asset, it will just be your cost or any other tax adjustment that is to be done to it. Is it clear? Is it clear?
Sir.
Hello?
Yes, sir. I can answer. Yes, sir.
Okay. So that's for tax. That's why I said for deferred tax liability, it is the tax that will arise in the future. It is the taxes that will arise in future period due to timing or temporary difference. Due to timing temporary difference. Why we also have deferred tax asset is that one is the opposite of deferred tax liability. It is those tax savings or those tax that will be recoverable in the future period. It is those tax savings or those tax that will be recoverable in the future period. And it is made up of three things, either as a result of deductible temporary difference. I will explain deductible temporary difference. Then it can also be as a result of carry forward of unused tax losses. So, you know, if you made a loss in a particular year, you are not to pay, you carry forward the loss to subsequent year. When you now make profit, you relieve the losses against that profit before you pay tax on the balance. You take out the loss from the profit before you pay tax on the balance. So if you have unrelieved losses, it is what? It is a tax, it is a deferred tax asset, because it will reduce your tax liability in the future. We calculate deferred tax asset on it. Then deferred carry forward of unused tax credit. So in some cases, your withholding tax might be so much that it will be more than your tax liability. So the remaining portion of your withholding tax credit that you haven't used, we call it what? We call it a we also take that as a deferred tax asset, because you use it to reduce your future tax liability. You use it to reduce your future tax liability. And it might also be that maybe you overpay tax to be available as a credit to you. But one thing about deferred tax assets is that you can only recognize as much as you are reliably sure that you will be able to enjoy in the future. That is, if you have a deferred tax asset, but you will not be able to enjoy it in the future, then you don't recognize it as a deferred tax asset. Because remember, the golden principle in accounting is we try not to overstate our assets. So if an asset will no longer be recoverable to you, you will not later receive the money. There's no point in recording it. So that is that. When we say temporary difference, it's just the difference between the carrying amount of an asset or a liability and its tax base. And it can be temporary, it can be taxable temporary difference, and it might also be what? Deductible temporary difference. It is taxable where in future it will result into what? To result into additional tax liability for us. And it will be deductible where in the future it will result into a tax asset for us. So that is that on that. Now, how do we calculate current tax? I mean, how do we calculate the income tax for the year? Having done the adjustments and calculate the income tax provision for the year, we had under provision of tax in the previous year to it. What do we mean by that? You know, as we have said, you know, in Nigeria, we practice this basis. We practice a self-assessment basis. So if it is, we practice a self-assessment basis. And when we say a self-assessment basis, that is, it is the taxpayer that will calculate what is their tax liability is, and they will go ahead and file. Now, when you file with the tax authority will check what you have done, if you have done it right or wrong. So they can come back and say, no, what you calculated is wrong, or what you calculated is not correct. Then they will ask you to pay the difference. So where we realize that current tax we calculated, which is the provision for the year, the one we did for the previous year was less than what it should be. That means what we would have recognized as an expense in the previous year is lower. So we need to recognize an additional one. That is why we need to have recognized an addition of the difference. So that's why we say we add under provision of tax in the previous year. Then if we have over provision of tax, with less over provision of tax, that is, if in that previous year you've over calculated the tax, then that one you will be deducting it, because it means what you charge as an expense was more than what it should be. So you need to deduct it. Then if we have increase in deferred tax provision, if our deferred tax liability is increasing, we had it. If our deferred tax liability is reducing, we deduct it. But the reverse is the case if it is deferred tax asset. So then when we add up all of that, it gives us what we recognize in our statement of profit or loss as the income tax expense. It gives us what we recognize in our profit or loss as the income tax expense, as the income tax expense. So the next thing we have is deferred tax. Now, like I said, deferred tax arises as a result of what? Deferred tax arises as a result of timing difference. Timing difference simply means where there is difference between the time where accounting will treat an information and taxation will treat an information, then we say we have timing difference. And that timing difference can either be temporary or what? Or permanent. It will be temporary where accounting treat it this year, tax will treat it next year or next 2 years or next 3 years. Or accounting has treated it, tax will also treat it. And it will be it will be permanent timing difference where even if accounting treats it, taxation will never treat it. That's what we call permanent. For permanent, we just ignore it when we are doing we take it out when we are doing our tax computation, and that's all. But for temporary, we now need to know if it will result into taxable temporary difference or deductible temporary difference. If it is taxable, that means it will end up giving us a deferred tax liability. If it is deductible, it will end up giving us a deferred tax asset. It will end up giving us a deferred tax asset. And how do we recognize the deferred tax asset? With deferred tax asset or deferred tax, if it is deferred tax liability now, the double entry will be to debit for deferred tax liability. The double entry will be to debit deferred to debit the if it is deferred tax liability, we debit it to our tax expense, income tax expense, and we'll credit it to where? We'll credit it to deferred tax liability account. But if it is deferred tax asset, we'll debit it to deferred tax asset account and we'll credit it to income tax expense. We'll credit it to income tax expense because it's a savings. It's a savings. Income tax expense. Then every year we'll now be treating it more like the way we treat provision. So if it increases, the increase will also go to deferred tax expense and it will also go to our deferred tax liability. But if it decreases, then we do the flip. We debit our deferred tax liability and credit our deferred tax we debit the deferred tax liability and credit our income tax expense. But if the deferred tax is arising as a result of revaluation, if it is arising as a result of revaluation difference, then the deferred tax arising on the revaluation difference will take it to where? Will take it to where the revaluation is. That is, if it's a revaluation surplus, revaluation surplus will be a revaluation surplus account. The deferred tax arising as a result of it will also go to the revaluation surplus account. But if it is a liability, if it's a deficit, revaluation deficit will go to the SOPL as an expense. So the deferred tax that is arising on it will also go to the deferred tax. Will also go to don't mind me, it will also go to the statement of profit or loss. So let's just look at some questions, then we'll call it a time on this standard. Alamide. Alamide. You are going, you have revival. You have revival. Eh, I never knew you are this spiritual. So you used to go to church. That's good. Well done. Okay, so that is that. Let's quickly look at some questions so that we can run away from this place. So question 1, we have for the period ended 31 March 2016, the directors of Example PLC estimated that a provision of 35 million should be made for the year. In the previous year ended 31st March 2015, income tax on 2015 profit has been estimated at 25 million, but this was settled with the tax authority on 25th of August 2016 for 28.5 million. The deferred tax for the year ended 31 March 2015 was 15 million, but the directors have adjusted to 13 million for the year ended 31 March 2016. Show the financial statement extracts for the year ended 31st March 2016. In the statement of financial statement extract, what we need is the SOPL and the SOFP. And what do we need in the SOPL? We need to the income tax expense. So we'll say question 1, Example PLC. So we'll say calculation of income tax expense. So our income tax expense will have what? Provision for the year. Provision for the year. How much did they say they are providing for the year? They told us that what? They told us that the profit, the taxation, the income tax on profit had been estimated to be what? 25 million. So we'll say naira in million, 25 million. That's the provisions for the year. But they said in the previous year, oh, sorry, that's one go. They said they have estimated that the provision of 35 million should be made for the year. Sorry, it should be 35 million. 35 million. Then what else? They now said income in the previous year, the income tax was estimated at 25 million, but they settled it with the tax authority for 28.5 million. That means they underprovided in the previous year. So we'll say add under provision in previous year. That will be 28.5 minus 25. And that will give us what? 3.5 million. Then what else? The deferred tax in 2015 was 15 million. But in 2016 is now 13 million. That means it has reduced. What do we say we should do to it? Well, let's decrease in deferred tax. Let's decrease in deferred tax. Which is what? 15 minus 13. That is 2 million. We are lessening it. So what will be our income tax expense for the year? What will be our income tax expense for the year?
Like 2.5.
36.5.
36.5. So if we are now to show our SOPL extract for the year ended 2017, so now be what? Expenses. What do we have? Income tax expense, which will be what? 36.5 million. 36.5 million. But in our SOFP extract, what we'll have there will be non-current liability, deferred tax, which is how much? 13 million. And current liability of income tax of how much? 35 million. Why are we having it that way? Don't forget, this 3.5, they've already paid it. This 3.5 has already been paid. The double entry for this 35 now is to debit our tax expense for the year, tax expense, and credit our what? And credit our tax liability. And credit our tax liability. But when this was paid, the double entry would have been to debit what? To debit tax expense because we underprovided in the previous year, and credit bank because payment has already been made. And why for these two? The double entry for these two would have been what? Would have been debit what? Debit income, sorry, debit deferred tax liability account, credit tax expense account, credit tax expense account. Do we understand? Do we understand? Question 5.
I don't understand anything. I don't understand
Eh?
the balance sheet statement.
Onfagbo, you come late to physical class, you still come late to virtual class.
No, I've been here since. I've been here
Okay,
since.
okay. I will pardon you because you said you have been here since. I'm just teasing you. Ah, Baba, as I was saying, so what did they, why are we having deferred tax to be 13 million? As at the end of the year, what did they say the deferred tax is? 13 million. That is what will go to our SOP, our SOFP. What we are just saying is this 2 million is what we use to reduce it from the 15 million it was before to 13 million. While our current tax for the year is 35 is, don't forget, this 3.5 has already been paid. This 2 million has been adjusted in the deferred tax. That means it's only this 35 million that will be our deferred, our income tax liability for the year. That's the provision we are making for the year. Does that make sense now?
Yes, sir. Yes, sir. Thank you, sir.
Please, that my small cord, that my small USB cord. Did you hear me say it? Yes. You are using it, Abi? No problem. So, question 5, we have what? The draft statement of comprehensive income of Arlington, a public company for the year to 31 March, shows an income tax expense of 55,000. The draft statement of financial position shows an income tax expense of 55,000. The draft statement of financial position shows a non-current liability of 280,000 for deferred tax, but does not show a current tax liability. Tax on the profits for the year to 31 March 2014 is estimated as 260,000. The figure in the draft statement of comprehensive income is the underestimate for the year to 31 March 2013. The carrying amount of Arlington's net asset as at 31 March 2014 is 1.4 million more than their tax based on that date. The tax rate is 25%. So what do they want us to do here? Compute the income tax expense also. So we'll say Arlington since it's a public company, we can call it Arlington PLC. Calculation of income tax expense. What do we have? We have provision for the year. What do they call provision for the year? The provision for the year is, they said, tax on profits for the year to 31 March 2014 is estimated at what? 260,000. Then what else do we have? We have what? They told us that the figure in the draft comprehensive financial statement is underestimate for the previous year. And what is that figure? 55,000. So we'll say add under provision or underestimate for previous year. 55,000. Then what else do we have? They gave us the deferred tax liability in the statement of financial position to be 280,000. But you will agree with me that that would have been the opening figure. That would have been the opening figure. That would have been the opening figure. Now, they now said what? They now said what? They said the net asset, the carrying amount of their net asset at the end of the year is 1.4 million more than their tax base. And when carrying amount is more than tax base, it will result into a deferred tax liability. Because what it means is that what we are having in the current year as depreciation is what? Is less than what we have as capital allowance, meaning we'll be paying lesser tax now, we'll now be paying higher tax in the future when we no longer have capital allowance, but we are still charging depreciation. So we'll have what?
So please go over what you just said again. Please, I did not understand you very well.
We'll have hello? Hello?
I did not. I can hear you. So I did not understand you very well. Can you go again?
What do we say? When I was explaining deferred tax liability or deferred tax asset or deferred tax generally, we say it's the difference between the carrying amount of a transaction and the tax base. Now, for the purpose of this, they've told us that the carrying amount is 1.4 million more than their tax base. That means carrying amount is more than tax base. If carrying amount is more than tax base, it will result into what? A deferred tax liability. A deferred tax liability. So since they've told us that the carrying amount is more than, we need to calculate their deferred tax. So we'll say calculation of deferred tax as at the year end, which is 31 March 2014. So since they've given us the difference, we'll just say deferred tax will just be 25%, which is the tax rate times that difference of 1.4 million. And that will give us how much? That should give us 350,000, Abi?
Yes, sir.
So if that is 350,000, then we can now say less. Is it less? No, we have add, because the discount, the deferred tax is also increasing. We had it to be 280 before, now it's 350. So we can say add increase in deferred tax provision, increase in deferred tax provision. So the increase will be what? 350,000 minus 280,000, which will give us how much? 70,000. With that, how much is the summation? How much is the summation?
385.
Okay, 385,000. So if that is 385,000 in our SOPL extract for our expenses, in our SOPL extract, we'll have income tax of what? We'll have income tax of 385. $385,000. In our SOFP extract, we'll have what? We'll have the tax liability will be what? Non-current liability, deferred tax. What is their deferred tax now? It is 350,000. Then current liability, what is their income tax? What is their income tax liability? It will be 260,000. Do we understand? Do we understand? Okay, we'll do what? So we go straight to question 2. We have what? Kotiele Limited. Kotiele Limited acquired the property several years ago at the cost of 500 million. At 31 March 2016, the accumulated depreciation on the property was 200 million. On 31st March 2016, the directors of XYZ revalued the property to 380 million. The depreciation rate and capital allowance rate on the property are the same, and corporate tax rate is 30%. Required, calculate the tax base of the property. B, calculate the taxable temporary difference. C, calculate the deferred tax liability and the accounting entries. We'll have what? Question 3. Kotiele Limited. What do we have? A, calculation of tax base. And how do we say we calculate tax base? It is cost of an asset, cost, which is how much? 500 million in this case, less capital allowance, And what's the capital allowance? They've told us depreciation rate and capital allowance rate are the same. That means capital allowance will be the same thing as accumulated depreciation of what? 200 million. So with that, we have tax base to be what? 300 million. The next, they ask us to calculate what? They ask us to calculate taxable temporary difference. B, calculation of taxable temporary difference. That will be what? To calculate taxable temporary difference, we have said that is the difference between the carrying amount and what? And the tax base. Carrying amount, we'll say carrying amount of the asset. But in this case, the carrying amount has been revalued. So it's the revalued amount we'll use. Revalued, which is how much? 380 million. Less tax base, which is how much? 300 million. That will give us how much? 80 million. Then C, we have to calculate deferred tax liability. The deferred tax liability will just be what? The tax rate multiplied by the taxable temporary difference, 80 million. And that will give us 24 million. D, we have to state the accounting entries. Accounting entries will be what? Because the deferred tax liability is arising on a revaluation surplus, we'll say debit revaluation surplus, credit what? Credit deferred tax liability with how much? With 24 million. With 24 million. Are we there? Are we there?
Yes, sir.
Number next, let's look at question 4. What do we have?
Sorry, sir. Please change. That one is question 2, not question 3.
Thank you. So, question 4, we have what? Maga Limited. Question 4 will be what? They told us Maga Limited acquired a property years ago at the cost of 700 million. At 31 December 2009, the accumulated depreciation on the property amounted to 400 million. On 31 December 2009, the directors of Maga Limited revalued the property to 250 million. The depreciation rate and capital allowance rate on the property are the same, while the corporate tax rate is what? 25%. First thing first, we are asked to calculate tax base. Calculation of tax base. We'll have what? Cost, which is what? 700 million less capital allowance. Just like the other one we did, capital allowance and taxation is the same, and depreciation is the same. So it will be 400 million. That will give us what? 300 million as the tax base. B, we are to do what? Calculate deductible. Calculation of deductible. They are even giving us that is deductible and taxable. So the moment they tell us is deductible temporary difference, we already know it will be a deferred tax asset. So we'll use the inverse of what we use here. We'll now say tax base, which is 300 million less carrying amount. Carrying amount, which is the revalued figure here. Revalued figure, how much? 250 million. 250 million. So in that case, it means we'll be having 50 million as our deductible temporary difference. So our deferred tax assets will just be the 25%, which is the tax rate on the 50 million. And that will give us what? 12.5 million. Then to state the accounting entities, it will now be to debit what? To debit the deferred tax asset account, credit SOPL with what? With income, because the revaluation deficit would have also been charged to the SOPL. That will be how much? 12.5 million. Do we understand? Do we understand? Okay, so let's quickly look at question 3. Question 3, what do we have? We have Workit Limited bought equipment for 1 million on 1st January 2012, and they depreciate it on straight line basis over estimated useful life of 5 years. For tax purpose, capital allowance is granted at 50% per annum. For the year ended 31 December 2012, the account showed a profit before depreciation of 800,000. The directors anticipate that this level of profit will be maintained for foreseeable future. We have to calculate the profit for the year over the 5 years period. So we'll have Workit Limited. Calculation of profit for the year based on using tax expense or let me say calculating tax expense on accounting profit. What do we have? We have 2012, 2013, 2014, 2015, and 2016. That's 5 years. So we can now say profit before depreciation. Figures quoted in thousand, all figures in thousands. $800, 800, 800, and 800. Then, what else do we have? We'll now say depreciation. What is our depreciation? The asset is 1 million and it will last for a year or 5 years. The depreciation should be 200 for each year. So what do we have as the profit before tax? Profit before tax, 400, 400, 400. Sorry, it will be 600.
Is it 400 or 600?
Should be 600. That's our PBT. Then we have what? Tax. At what they did not give us, so let's just use at 30%, which is the average rate. 30% will give us how much? 180, 180, 180, 180, 180. So with that now, the profit for the year will be what? 420, 420, 420, 420, 420. Okay? That's for that. Now we are also to calculate profit for the year over the 5-year period. Tax expense should be based on taxable profit and deferred tax should be ignored. We are to do this. We'll say what? First thing first, before we go to calculation of profits for the year, we'll first need to calculate what is our taxable profit and what is our tax based on taxable profit. First need to calculate what is our tax. Oluwakemi Adesanya, you are raising your hand. What's the issue? I don't check the distance. If you have any question, just unmute your mic and talk. You can't see my screen anymore. Please log out and rejoin. You will see it. Once you log out and rejoin, you will see it. I hope others can see my screen. Can others see my screen? Yeah, so it's from your hand. Just log out and rejoin. So this is A now. This is workings 1. Calculation of taxable profits and tax liability for the years. So we'll have profit before tax, which is 600, 600, 600, 600, and 600. Then we add back depreciation because it's a disallowable expenses. Depreciation, which is 200, 200, 200, 200, and 200. Then with less capital allowance. What did they say capital allowance is? 50%. So 50% on the cost of the asset is what? 500,000. In the second year again, 50% of cost, 500,000. But after those 2 years, the asset has fully enjoyed capital allowance. It can no longer enjoy again. So the remaining years will be nil. So based on this, the profit before tax or the taxable profit will be how much?
$300.
The taxable profit will be 300, 300, 800, 800, 800. And the tax liability will be what? At 30%. So tax liability at 30% will be what?
90.
So here it will be 90, here it will be 90, here it will be what? 240, are we? 240 and 240. So having done this now, we can go to requirement B, which is calculation of profit for the year. With tax expense, on taxable profit. Ignoring deferred tax. Okay, so we can just start with PBT. Our PBT is what? 600, 600, 600, 600, 600. So our tax for the year will change now. The tax at 30% will be what? 90, 90, 240, 240, 240. So with this, we have what? Profit for the year of how much? 510, 510, then 360, 360, okay? Do we understand? Do we understand? Hello?
Yes, sir.
Okay. The next is for us to calculation of tax base at the end of each year. So we'll have what? To calculate tax base, I need cost, which is 1 million. Less capital allowance. Capital allowance, like we did here, is 50%. So it will be 500 in year 1. Year 2, they've charged 2, it will become 1 million. But after year 2, there is no capital allowance again, so it will just remain at the same 1 million. So that will give us how much as the tax base in the year 1, 500, in year 2, nil, in year 3, nil, in year 4, nil, in year 5, nil. That's for the tax base. Then we are asked to calculate the yearly temporary difference. For us to calculate yearly temporary difference, we need to calculate what is the carrying amount of the assets. You can say workings 2, calculation of carrying amount. Calculation of carrying amount as at end of each year. We have what? Costs less accumulated depreciation. Cost is how much? 1 million. Accumulated depreciation in the first year will be 200. That will make carrying amount to be 800. Cost in the second year is 1 million. Accumulated depreciation will be 400,000. 600. Cost in the third year 100. Accumulated depreciation 600. That will give us what? 400. In the fourth year, the cost is what? 1,000. Accumulated depreciation 800. Carrying amount to be 200. Then in the last year, cost is 1,000. Accumulated depreciation is also 1,000. That will make it nil. So if tax base is A and accumulated depreciation is B, we can now go to requirement D, which asks us to calculate yearly difference. Calculation of yearly temporary difference. So the temporary difference, which is still D, will be B minus A. B minus A because carrying amount is higher than tax base. So that will give us how much? 300 in year 1, 600 in year 2, 400 in year 3, 200 in year 4, 0 in year 5. Do we understand? Temporary difference is what? Carrying amount minus tax base. And because all of it are positive here, which shows that carrying amount is greater than tax base at the end of each year, we can now say workings 3, calculation of deferred tax. But in this case, it will all be liability. And what will be the deferred tax? It will just be the rate 30% of temporary difference, TD. So 30% of 300, 90, 30% of 600, 180, 30% of 400, 120, 30% of 200, 60. Then, okay, so here it will be 0 because 30% of 0 is 0. So having done this, why am I doing deferred tax liability? Because E requires me to calculate year-end profit and deferred tax should be included. So if deferred tax should be included now, we'll now need to recalculate workings 4, calculation of income tax expense. inclusive of deferred tax. So what do? We'll first go back to where we calculated the profit, the tax. We calculated the tax to be what? 90, 90, and 240 for the 3 years. So we'll say current tax 90, 90, 240, 240, and 240. Then increase or decrease in deferred tax. Increase or decrease in deferred tax liability. In deferred tax liability, because at each and every case, we have the carrying amounts greater than the tax bill, which means also we have a taxable temporary difference. So what do we have? If deferred tax was 90 in year 1 and there was no one before it, that means deferred tax, we can say deferred tax increased by 90 during the year. Abi? Between year 1 and year 2, it also increased by 90. Year 2 and year 3, it reduced by 60. We'll take that out. Year 3 to year 4, it reduced by another 60. Year 4 to year 5, it reduced by another 60. So what do we now have as the tax, as the income tax expense? We have 120. Sorry, 180. 180. 180. 180. Then 180. So if that's the case, we can now go to note E. In note E, we can now say calculation of each year profit inclusive of deferred tax. So what do we have? We have
Sorry, sir. Excuse me, sir.
profit
In
before tax.
are you
Yeah?
hearing me, sir? In that current tax, how did you get 240? I don't understand how we got 240.
We calculated current
No, no,
tax
no,
here.
no, 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 no. No, don't go up.
Baba,
Okay.
it's the same current tax we've calculated here. We are repeating there now. Current tax will not change.
Okay.
Do you understand?
Yes, sir.
So 600, 600, 600, 600, and 600. Then the tax expense now will now be what? Based on this, it is now 180, 180, 180, 180, and 180. So that way our profit will be what? 420, 420, 420, 420, 420. So why? Because in each of the year, the deferred tax, recognizing deferred tax has now helped us to regulate the profit. So the profit, if you look at when we did not use deferred tax, the profit was much in year 1 and year 2. Then it dropped drastically in year 3, 4, 5. But with this now, profit are now remain the same over the 5 years. So it doesn't make us charge make us put lesser amount as tax in year 1 and now have higher amount as tax in year 5. Makes the everything to be what? To be on a fair basis. Do we understand? Do we understand? Huh? Okay. So let's look at the last question, and we'll call it a time on this standard. Question 6. We have Yemnight Nigeria Limited as an accounting profit before taxation of 225 million for the year ended 31 December 2017. The following are extracts of the financial position of Yemnight Nigeria Limited as at December 31, 2017. Building, plant and machinery, and so on. The following information is relevant. The building was acquired by the company at the cost of 175 million at the start of the year, and it is the policy of the company to depreciate building at 10% per annum on straight-line basis. The company tax consultant have stated that the company can claim 105 million capital allowance this year on the building. The balance in respect of plant and machinery is after providing for depreciation of 30 million, and the capital allowance claimable on it is 25 million. Assets held under finance lease was acquired during the year. The relevant tax law does not distinguish between finance lease and operating lease. Rental expense for lease is tax deductible. The annual lease rental is 20% per annum on straight-line basis, while annual finance charge amounts to 36,667 million. The receivables figure is shown at net of an allowance of doubtful debt, doubtful balances of 17.5 million. This is the first year that such an allowance has been recognized. The deduction for debt is only allowed for tax purpose when debtors enter liquidation. Interest income is taxed and interest expense is allowed, both on cash basis. There were no opening balances on interest receivable and interest payable. Provision for fines and penalties are not allowable deduction for tax purpose. The fines payable is a provision made during the year. We have to calculate this. Please spare me 1 minute. Okay, sorry for that. Can you guys hear me now? Can you guys hear me?
Yes, sir. Yes, sir.
Okay, so we have Yemnight Nigeria Limited. We'll say what? The first requirement is what? We should calculate current tax expense for the period. Calculation of current tax expense for the period. So to calculate current tax expense for the period, we'll have what? Naira in thousand. So to calculate current tax, we have said that what? We do that by calculating the taxable profit. We calculate the taxable profit and we'll be able to okay. We'll have what? First thing first, profit before tax. Profit before tax. For those of us that are taxation savvy, this will not really give us issue. 225 million. We had disallowable expenses. We'll add disallowable expenses and we'll less allowable expenses or allowable items. So RDB, they gave us SOPL. It would have been much easier, but they gave us only SOFP. We just take the notes one after the other. They said what? The building was acquired by the company at the cost of 175 million at the start of the year, and it is the policy of the company to depreciate building at 10% per annum. That means they would have charged depreciation during the year. So we'll say depreciation is a disallowable expense. Depreciation on building. Depreciation on building that's 10% of the 175 million, and that will give us how much? 17,500. Right, all right? But the capital allowance now that is claimable will now be allowable. We'll now say less capital allowance on building. 105 million. Are we getting it? The next one, they said the balance in respect of plant and machinery is after providing for depreciation of 30 million. So we'll say depreciation on plant and machinery. $30 million. Then they say capital allowance claimable is what? Is 25 million. Okay. The next thing is that what? They said the assets held under finance lease was acquired during the year. The relevant tax law does not distinguish between finance lease and operating lease. What does that mean? Tax law does not recognize leases as assets. But rental expense for lease is tax deductible. And they gave us what the annual lease rental is to be 72 million. Annual lease rental will be allowable. So annual lease rental, 72 million. If that is allowable, the depreciation on the lease, because they were recognizing the lease as an asset, see, assets held under finance lease will be disallowable. So we'll say depreciation on leased assets. However, they did not give us the amount of the depreciation, but they told us the depreciation is on 20% per annum straight line. And since the lease was taken during the year, since the lease was acquired during the year, we'll now say what? The figure we have here would have been the carrying amount, which will be 80%, because they would have charged 20% as depreciation that year. So 80%. So we can now say 200,000 divided by 80%, 0.8. That will give us the 100% of the figure. Then if we now multiply it by 20%, it will give us the depreciation they have charged, which is how much? Hello? Hello?
I've lost you. Why are you using the 0.8?
Because the 200,000 they give us in the statement of financial position is carrying amount, and if they are charging depreciation at 20% per annum, then the carrying amount would have been what? Just 80% because they've only charged 1 year depreciation. They've only charged 1 year depreciation. So we want to know what is the amount of depreciation they charge. Then we what? We take it back to 100% by dividing by what? By dividing by 0.8, which is the percentage of this one that is remaining. So if we now multiply it by 20%, it give us the depreciation they charge. Figure
50,000.
So 50,000. So you will agree with me that if we had this 50,000 to the 200,000, that would have given us the 250,000, right? Is that not it? So if it gives us 250,000, if you calculate 20% of 250,000, if we give you the 50,000 we have as depreciation for the year, and if you take it out from the cost, it will give you the 200,000 you have as the carrying amount in the statement of financial position. So number next, we have what? Okay, there is still finance charge on that asset, finance charge on the leased asset. Those are it is depreciation and finance charge they take to SOPL in relation to that finance asset. So that is that. Okay, after finance charge, we have what? We have the receivable figure. It shows. Huh?
It's still confusing me. Why do you have to divide
Huh?
by why do you have to divide by why do you have to divide by 0.8?
Baba, are you not listening to me?
200,000
The
is now.
200,000 they gave you.
I'm not understanding.
Huh?
Go on, sir. Go on,
The
sir.
200,000 they gave you in the statement of financial position, is it not carrying amount? And how do you get carrying amount? After you, it's not in that place you are. The 200,000 they gave us in the statement of financial position is carrying amount. And carrying amount will be gotten after they've deducted what? After they have deducted depreciation charge for the year from the figure. We don't know what the depreciation charge they deducted was, but we know it was calculated at 20%. That means whatever we have in the books will now be what? 80%, because that asset was acquired that year. If they told us that asset was acquired 2 years ago, then we would have divided it by 60%, because we know if they've charged year 1, year 2, 20%, what should remain in the books should be 60%. Is it clear now? Hello? Okay. They said the receivables figure is shown net of an allowance for doubtful balances of 17.5 million. This is the first year that such an allowance has been recognized. A deduction of debt is only allowed for tax purposes when the debtor enters liquidation. So they've created a allowance for doubtful debt. But the tax law only recognizes allowance, only recognizes deduction from receivables when the debtors has entered liquidation, that is, when the debt has become bad. So what does that mean? It means the allowance for doubtful debt will not be allowable for tax purpose. It will not be allowable for tax purpose. So what do we do to that? We'll add it back. Allowance for doubtful debt. Allowance for doubtful debt. 17,500. But it is easier because they told us this is the first year such an allowance is created. If this is not the first year this allowance is created, what we would have done is the allowance they deducted from receivable at the end of the year minus the allowance they have at the beginning of the year is what would have been what we would take in, because that is what they would have taken to their SOPL. Remember, in SOPL, we only take increase or decrease in allowances there, not the allowance calculated at the end of the year. Is it clear? But since this is the first year, the allowance calculated at the end of the year will still be the same thing as the increase for the year. Do we understand? Hello? Are we following? Okay. Having said that, they said interest income is taxed and interest expense is allowable, both on cash basis. If there were no opening balances on interest receivable and interest payable. If they are taxed and allowable on cash basis and we are having it on accrual basis, that means it will not be permitted for taxation purpose. So for the interest receivable, it was added before as an income, so we'll take it out as an expense because it is yet to be what? Taxable. It is not yet taxable. So we'll say interest receivable 2,005. Then interest payable, it is not yet allowable, so we'll add it back also. Interest payable 8,250. Then what else? They said since there is no opening balance, that's why we are not adjusting that also. If there was opening balance, we would have taken the difference between the opening balance and the closing balance, because that is what would have transpired during the year. For provisions are not allowable. So what do? We'll say fines. They said the fines provision was just made during that year. So we'll just take the full figure, 25,000, and take it out. But if there was a provision at the beginning of the year, the difference is what we would have bought here. Is it clear? So please give me the total figure for the disallowable expense and the total figure for the allowable expense. Oh yeah, do I have people on this call? Hello? What do you call it?
205.5 is for the allowable expense.
205,500.
No, for the
Are you sure?
allowable. For the allowable.
Okay. For the allowable. Okay. 205,500. We are deducting that. What about the disallowable?
The other is 13 for 17.
Huh? I can't see. 134
917.
917. So what do we have as the taxable profits?
15417.
Huh?
154.
154.
417.
It's not correct.
One.
It's not correct.
Oh yeah, give us your own figure now.
The allowable expenses is 184,917. 184,917.
184,917. Can someone confirm that? Can someone else confirm that? Okay, you are right. 184,917. What about the allowable? That one is correct, Abi. So what do we have as the
204,500.
204,500? Okay. So what do we now have as the this thing? That should give us 205,417, Abi. $61,625.1. That's our current tax. Do we understand? Do we understand?
Yes, sir.
Okay, the next requirement is for us to calculate the deferred tax liability. So say calculation of deferred tax liability. As at 31 December 2017. So we have items, we have carrying amounts, we have tax base, we have temporary difference, then we have deferred tax liability or deferred tax asset at 30%. At 30%. So what do we have? The first item we have on our statement of financial position is building. For building, carrying amounts, don't bother yourself. Whatever you have on the statement of financial position is the carrying amount. That is 157,500. But for tax base will be the cost minus capital allowance. So for building, they gave us the cost to be 175 million. So that will be 175 million minus, what's the capital allowance? 105 million minus 105 million. And that will give us how much? That will give us 70 million. 70 million. So if that's 70 million, our temporary difference, which is allowance minus tax base, will be what? 87,500. And because carrying amount is more than tax base, that will result into a deferred tax liability. So the deferred tax liability will be 26,250. That is 30% of the time of the temporary difference. Do we understand? Do we understand? Hello?
No, sir. I repeat it, sir.
Carrying amount has already been given in the question, which is cost minus capital allowance, minus depreciation, accumulated depreciation. For tax base is just cost minus capital allowance, which we've done before. In this case, cost is 175 million. Tax base, capital allowance is 105 million. If we deduct it, that gives us 70 million. So if we now deduct tax base from capital allowance, from carrying amount, it gives us what? The temporary difference. And that temporary difference, if we apply the tax rate on it, it gives us the tax, the deferred tax, which will either be asset or liability. Is it clear? But in this case, it will be a liability because carrying amount is more than the tax base. Is it clear?
Yes, sir. Yes, sir.
Okay. The next one is plant and machinery. The next one is plant and machinery. So for plant and machinery, we have the carrying amount to be 250,000. For tax base, we don't know what the tax base is also, but they told us that the balance we have here of the 250,000 is after they have charged depreciation. So if we say 250,000 plus that depreciation of 30,000, it will give us back what the cost of the assets should be. Then when we now deduct capital allowance of 25 million for it, to give us what the tax base should be. Do we understand? We don't know what the cost of the asset is in the case of plant and machinery, but they gave us the carrying amount and the accumulated depreciation. Since carrying amount is cost minus accumulated depreciation, carrying amounts plus accumulated depreciation will give us cost, which is why we have done the 250,000, which is carrying amount, plus the depreciation of 30 million. Then we now less the capital allowance so as to get the tax base. Is it clear? Is it clear? So that will give us 255,000. And the timing difference will be what? 5,000 negative, which shows is a deductible temporary difference. And that will result into what? A deferred tax asset. So, and the deferred tax asset will be what? 1,500. Put it in negative. The next one we have is the asset held under finance lease. They told us that the relevant tax law does not recognize finance lease. So what do? We'll just take it out. How do we take it out? We'll say assets held under finance lease. Leased assets. How much? The carrying amount is 200,000. But since the tax law does not recognize it, it will not have anything as tax basis. That means the timing difference will be what? 200,000. A taxable timing difference. So that will result into what? A deferred tax liability of what? Of 60. Do we understand? Hello?
Yes, sir.
Okay. We move to the next one. Trade receivables. For trade receivables, the carrying amount is 182,500. For tax base, it will be the 182,500 plus, don't forget, for them to arrive at this 182,500, for this one, for them to arrive at this 182,500, they deducted 17.5 million, which is the allowance for doubtful debt. So, but for tax purpose, since allowance for doubtful debt is not recognized for tax purpose, we have to add it back. So the tax base will be what? 200,000. So with that, our timing difference will be what? 17,500 negative, which shows is a deductible timing difference, and that will give us what? That will give us a deferred tax asset of how much? 5,250. We move to the next one. Interest receivable. Interest receivable is how much? 2005 for tax for carrying amounts. But since they said it is only taxable on cash basis and they are yet to receive it, so that means it will have zero balance for tax base. So that makes it what? A 2,500 taxable difference. And for that, we'll have how much? We'll have the deferred tax liability arising on it to be what? 750. 750. Then we move to the next one. So in the case of liabilities now, the reverse will be the case. If carrying amount is more than tax base, that will be a deferred tax asset. If tax base is more than carrying amount, that will be a deferred tax liability. So the first one, fines. They've told us that fines is not allowable for tax purpose at all, either now or later. So that means fines will result into what? A permanent difference. So if it is permanent difference, it will not result into deferred tax. It will not result into deferred tax. That one is lost forever. So we move to the next one, finance lease obligation. Finance lease obligation. The same way we did not recognize the assets, we will not recognize the obligation. So finance lease obligation, which is how much? 216,000. Since the tax law is not recognizing it, it's not having any basis there. So that will result into a what? A deductible temporary difference of 216,000. And that will give us what? And that will give us 64,800 as deferred tax assets. Then after that, we also have what? We have interest payable. Interest payable, just like interest receivable, is not recognized for tax until it is paid. So the tax base will be nil. And as such, we will have a deductible temporary difference of 8,250. So that will give us a deferred tax asset of 2,475. So with this, what will be the net deferred tax asset or deferred tax liability? We'll have it to be what? That will give us 12,975 deferred tax liability because it's a positive figure and our deferred tax liabilities are the positive figure here. So, any question? Any question? Any question? So to calculate the tax expense for the year, we'll now have what? The current tax. We calculated that to be what? 61,625.1. We don't have any under or over provision in the previous year, so we'll just say add increase in deferred tax liability, because they did not tell us there was any deferred tax before, and even in their statement of financial position, we can't say any deferred tax there before. So we'll have this to be how much? 12,975. And that will give us how much in total? 74,600.1. So even though they did not ask us, if we are to show the SOPL extract, we'll have what? Income tax expenses. That will be 74,600.1. Then in our SOFP extract, we'll have what? Under our non-current liability, we'll have deferred tax liability at 12,975. Then under our current liability, our income tax liability will be 61,625.1. And that will be all. Any question? Any question? Any question? Ladies and gentlemen, that will be